I think there's a bit of autopilot going on, especially when you look at equities. I mean, the issue right now is you look at 10-year treasuries, they can't really rally or they can't really sell off through 160. Bunds can't get through neg 40, but equities are just on this escalator up at this point. I think once you start to get the bad data, that's what I think markets are really looking at to start to bite their teeth in and see how bad does this actually look like it is.
When do we get the bad data? Because the data hasn't really been that bad. I mean, the human toll aside, the economic numbers in the U.S. are modest and still growing, and other parts of developed Europe are not so bad. So when will we see this bad economic data or earnings data?
And I think this is the issue. We'll just get the very first surveys that at least have, the early bad parts of the virus getting into them over the next couple of weeks. You'll get the PMIs coming through Europe. But China's delayed most of that hard data because of the Lunar New Year and because of the way the virus came through. So you're really going to be waiting until the end of next month before you start to get some of the more significant hard data out of China. Before that, you'll start to see some of the trade data at the very start of next month around the region. That's when we can start to put these pieces together. You get a lot of anecdotal evidence. You get a lot of firms, like you mentioned, coming in, talking about when they think their factories will be open, what the capacity will be by the end of February, by the end of March. It still seems like we'll have a lot of factories running at maybe 60 and at an upside 80% capacity by the end of March. So the idea of a V is probably gone. It's probably going to be more of a U-shaped recovery at this point. And so it's just a question of how much drag is still there into the second quarter.
All right, let's assume that your forecast is correct. We'll give you the benefit of the doubt here, Richard. What exactly then do your clients, what do TD Securities clients do to position themselves given all of those particular variables that you've just laid out?
Well, I think, right now when you're looking at it, being long the dollar, if you're looking on an FX side of things, I think there still is risk the way that the capital flows are going, especially you look at euro that's been falling out of the bed. The portfolio side of the equation is hurting euro. The funding side of the equation is hurting euro. And the data as it feeds through coming out of Asia into Europe is going to be hurting euro. So this argues that we're going to see a bit more dollar strength. That's never good for overall risk sentiment. That feeds through into the fixed income market where, again, you look at 10-year treasuries and you look at the limited amount of spillovers we've had into U.S. data, and it still should be somewhat modest. You might see up to half a percentage point shaved off U.S. GDP, but that still means it's going to be very difficult to talk about higher yields at this point. So I think, you're still looking for the opportunities to be long. The problem is the risk reward isn't great. Until we start to get some of that data through and we can really pinpoint, it's tough to see how quickly some of these things can turn. You can look at the moves in dollar yen overnight, where sometimes those normal trading positions are going through. They're just not operating the way that they once did.
All right, before we let you go then, given everything that you've just laid out there, is there a real chance that we see a bigger pullback in U.S. markets, specifically with regard to those record high equities?
I think when you look at the where valuations are, you look at where growth is. I think once you get that data, there does look like there needs to be some sort of pullback and reassessment, at least sectorally going on there. The sort of autopilot we've been on just isn't sustainable. But I still think the issue is there just aren't other places to park your money. You still have central bank support.
Sure.
So I think while you can see some bit of pullback and correction, it's still difficult to break out of that trend.